the privilege of being the only woman, so I'm the first of the row.
Right. Just so that you're not confused when you see the photos on
The order, okay.
So I understand that I need to quickly introduce panelists, even if...
you don't necessarily need to. You don't need to. It's been shown up.
Okay, so thank you very much. So you all know them, are very known actually. And as for myself, I want to thank you, Afore, for having me here in representation of the Italian security regulator, CONSOB. And allow me to start with a very positive note, just to kick off by telling you that at the time of reflections to transpose the DLT pilot regime at national level, we understood that there were obstacles in our civil law, and along with the very positive examples from some other jurisdictions, we decided to introduce changes to our legal framework, so as to give a third option to paper and book entry form, the digital form for securities, going even beyond the perimeter of the DLT pilot regime, because that was introduced for any type of securities. And that was done to pave the way to new technology and allow for tokenization. And why I use this example to kick off, just to testify that not just the industry, but also government and regulators are willing to open to new technologies as long as these are conducive to additional efficiency, financial inclusiveness, I would say, but not hampering investor protection and market integrity. Let remain on the public sector side, and if I may give the floor to George to take us through some background for the European journey since the publication in September 2020 of the Digital Finance Package. And please provide also with some insights for the initial implementation phase for both MiCAR and the DLT pilot regime.
Good afternoon, everyone. First, let me thank Nick and Afore Consulting for inviting me and for this very interesting conference. So let me just say, in terms of the tokenization and DLT, that for me was always DLT blockchain technologies always had a lot of potential. Until now, though, what we have been seeing basically was, the association of the technology with some, crypto assets and some frauds and scams that we have seen basically from in the crypto industry. And that doesn't give service, I think, to the technology, because the technology it's extremely useful. And tokenization is part of what the technology can achieve for the future. And let me just say here that back in 2016, I was involved in an initiative back in my home country, Cyprus, where we have established, together with collaboration with the UCL Center for Blockchain Technologies, we have established the first think tank in Cyprus called Cyprus Blockchain Technologies. I was the first chairman. And the idea of that basically is to see the use of this technology. How can it be applied in the financial services, in the banking industry, and in other industries as well? And when we're coming now to Europe, and after the digital finance package, we've seen that there has been a lot of initiatives that have been taken. As you, Martina, as you pointed out, there have been a couple of regulations which are very important. Obviously, MiCA is a very important regulation for the crypto asset industry and for the digital assets in general. Yes, MiCA has been put into effect in force by the January 1st of this year. there is a lot of potential, there is a lot of interest for regulated entities to get a MiCA license, and I think that would be a good thing for the industry. It will provide trust to the industry, and it will be good for the European citizens, because there would be certainly a much greater security for the European citizens when trading these types of assets, and something that we have not seen in the past, and something that led to certain frauds and scams, which created a bad image, unfortunately, to the industry. And then obviously we have the DLT pilot regime, which started in 2023. The idea of the regime is to be used as a sandbox, basically, where regulated entities or other entities that want to apply the technology, the DLT technology, can, under specific conditions, to test the particular technology, supervised by the regulators for a specific time period, and to see whether that technology is useful and can be scaled up. And I think there is a momentum. We haven't seen, since 2023, we haven't seen a lot of initiatives, a lot of entities getting into this. But I do feel that we will see that in the future. And there is, I think, a momentum now for the digital assets because of MiCA, because of DORA. You know, these are important regulations. And let me just, I'll close here. I think, you know, these will probably be the future of the financial services industry. Now, when will that happen? You know, a decade from now, 2 decades from now, but the future will be the digital assets, right? So everything will be digitalized, whether it's shares, whether it's bonds, whether it's real estate, whether it's art, whether it's intellectual property, everything will be in a digital form. And it will take time because it needs to scale up. Now, right now, we're in a much, the initial phases, I should say, of this new era. So I'll stop here.
Yeah, thank you, George. Let's move now overseas. I would ask James to tell us something about major development in the US and what this may entail for Europe.
Great. Thanks, Martina. And thank you, Nick and Afore, for the invitation to speak. This is a very important, very interesting panel. And I fear I'm going to say very much what George has just said. Momentum. I think momentum is the word. Just a quickly overview of how we see the current state of digital markets, or rather markets and digital financial instruments in Europe today. First point, of course, is they're still small. They're still limited in comparison with traditional financial instruments. That's clearly the starting point. Yet, as George mentioned, I think last year we have seen significant increase in issuance of, in particular, bonds, driven in good part by initiatives from the European Central Bank and the Swiss National Bank. So that's one part of the momentum going forward. Another part of the momentum going forward is, I would probably say MiCA has played a big part in it. Another part of the momentum going forward is the development of the ecosystem. We are starting to see different types of market participants, of players, coming out, setting themselves up, forming part of the market. So all to say, definitely there is momentum, but we're still at a starting point. Just to say a final brief word before we go to the future, but a brief word on 2025. I think 2025, and it's not my word, I've taken it from somebody else, but I think 2025 will be the year of the stablecoin. So that's where we are. Thank you.
Thank you very much. Tom, I see that you already took the microphone. I'm sure you also would want to introduce some comparative elements into the discussion, as your company is also very active in the States. So.
Yeah, happy to. Thanks, Nick, for bringing us all together. Thanks, Martina. Definitely, we're at an inflection point, right? That's what I think. We're a US headquartered company. At Coinbase, we're probably the largest kind of listed digital asset player globally. But we've been for a long time struggling with kind of regulation by enforcement on the US side and a lack of clear rules. And we've always actually looked back over the Atlantic, back here at the EU, and been super impressed by MiCA, right? Because actually 27 countries got together, developed a comprehensive, and we think kind of overall very sensible kind of level 1 regime. So I think that's good. But with the US is now going to move very fast. Some of you will have seen the executive order that came out. There's another announcement that's going to come out later today with regard to what David Sachs is saying and the leaders of the major kind of committees. So things are going to move fast. We could even see market structure and stablecoin kind of legislation in the US within 8 months to 12 months, something like that. But the EU has a head start, and our view is that now is the time for the EU to get on and implement MiCA and to start commercializing it, right? Because there are so many kind of amazing opportunities. This panel is about tokenization. What was good about MiCA was that in parallel with MiCA, we had the DLT sandbox regime. And that was a recognition that we're not just talking about, payments and stable coins and meme coins, but actually we're talking about the technology, right? Blockchain and what that can do to totally transform capital markets. And I think what I quite like about kind of where we are this year is that I'm not sure that we have to rehearse on panels like this again that blockchain is a better version of value transfer. I don't think we have to do that anymore. I think that's well known. I think it's super well understood. The efficiencies you get from that, from a kind of cost perspective, from a time perspective, I think we know that's where the future is. George said it, I think, very compellingly, and it's our conviction at Coinbase too. We're seeing cash come on-chain very rapidly, stable coins, but we're going to see now funds. We've seen a lot of fixed income funds come on-chain. We're going to see all financial assets, I think, come on-chain over time. We know what the destination is. The question is, how long is it going to take us to get there? And what are the ways in which we can kind of speed that up and try and commercialize it? But I think, this is an exciting moment. And for Europe, let's tweak the DLT regime. I think there are some aspects of that could be changed. I think the issuance limits, the kind of aggregate kind of, thresholds on value, things like that. Let's get more projects in there. And in parallel, if we know what the destination is, let's already start to think about how we should be, amending some of those other rules and regulations and on post-trade so that we can move forward. And then final point, Martina, is let's think about the settlement asset. So in order to kind of extract the maximum benefit from this technology, we need to have on-chain kind of settlement assets and cash. What is that going to be? Is it going to be a wholesale CBDC? Is it going to be a stable coin? I think we should look at the US there as well. And it's very clear on the US side that they are not going to be using a CBDC. So the world's largest economy with one of the biggest capital markets is probably going to be using some form of fiat-backed regulated stablecoin. So I think it's important in Europe to bear that in mind and to think about preserving optionality to use the digital euro in some of these contexts, but also use things like tokenized deposits potentially and euro fiat-backed stablecoins.
Yeah, you just gave a very innovative perspective because in Europe, on the contrary, it's always been based, we've always relied on this possibility to settle the cash leg with central bank money in digital form. So it really changed the perspective. But from what we heard also this morning from Verena, actually only 2 DLT infrastructures have been authorized so far. So it seems that tokenization is still, maybe 2025 will be the year of change. But let me ask Fabian from the Moody's Observatory in this context, what it's the real appetite around the world for tokenization, and which are the major trends that you had the chance to see at this point in time?
Thank you. I was hoping Tom would use the word momentum like George and James, because I'll start with that. There is good momentum. And I'll illustrate the point with DLT bonds. It's tiny still, as you said. Since the first bond in 2017 issued on a blockchain platform, there's been 88 of them. Actually 91 if you include the 3 that were issued in January of this year. So pretty small. That said, 65% of those bonds were issued in 2023 and 2024, and 43% roughly of them were issued in 2024 alone. And again, 3 just at the beginning of this year. So there is some clear acceleration, and it's not just for DLT bonds. We've seen it for real estate experiments and a bunch of others. So it is already happening. Back to the point that James made, it's still small. In fact, even the average notional of those bonds is pretty tiny compared to actual bonds, yet it's there. Now, with all the promises of tokenization, we talked about a few today. We talked about process efficiency, we talked about cost savings and enhanced controlled environments, faster settlement, and all that stuff. It looks like it should be already available at scale, and it's not. Why? There's a number of obstacles. I have some good news and some bad news. The bad news is that I think it's the third or fourth time in a row that I'm here. The only difference is that we're no longer virtual this year. And the obstacles were the same in our previous panels. I think, Tom, you were on those panels too. But the good news is that there is some real progress. So there's one that you all talked about, which is regulatory clarity. And thanks to initiatives by a number of governments globally, and regulators and supervisors and legislators, finally the market is getting the clarity that it was asking for, and that really helps people innovate, essentially. You don't want to innovate if you don't know if your innovations can be illegal, essentially, 2 weeks later. So that was a key point, and that's getting a lot better. The other one is what you said, Tom, is a lack of digital cash, and we talked about them earlier today. There are many options, but nothing really available at scale. You have stable coins, not really regulated yet. It's probably going to be for this year, at least in the US, and that should boost the ecosystem. But people are still telling us, hey, you want us to invest, not us Moody's, but the market wants us to invest in digital infrastructure to manage those bonds, funds, stablecoins, and others. But at the end of the day, I still have to get off chain to do a good old wire transfer payment to settle, and it defeats the point. But more than that, there's been, for the longest time, a gap between supply and demand in the space where you have everybody ready for the issuance of digital assets. You have experts in the field, you have structures, you have technologists and lawyers. Everybody's getting ready. Regulators are getting ready to keep an eye on those assets. And on the demand side, on the investment side, it's always been like very confusing for everybody, with the sense that blockchain equals Bitcoin equals FTX equals all those things together, so that investment committees are very reluctant to say yes to those investment opportunities. So that got better over time, because more and more, and that's the shift, George, that you mentioned before, things moved away from crypto, and people realized that it was not crypto for the sake of crypto, but instead it was reshaping financial markets with better, faster, more efficient technologies. And with that, people got more comfortable with the space, but yet there's still something. Investors say, well, we still need to get ready, and it costs money to get ready. It costs money to have that infrastructure ready to be part of the digital ecosystem. And you have talked about the promises of tokenization, including lower costs. So we need to see some discount somewhere. And today, it's not the case. Today, essentially, it's more expensive to be in the digital space. Quite often is that for digital issuances, for instance, you have a non-digital twin somewhere so that issuers can port things overnight to the non-digital component of the bond or the fund to mitigate risks. And the market is saying that, like, until you have demonstrated that those gains are true and realized, it's going to be hard to get in. So it's a chicken and egg question. And so what's going to be the trend this year, and it started last year, and actually a tiny bit the year before, is the overlap between digital finance and other areas like private credit or transition finance. And people started to see, all right, now I see that there are things that I can do with DLT and digital finance overall that I would not be able to do otherwise. And that includes green bonds and the reporting that's very heavy on requirements, for instance, and a bunch of things, obviously, with fractionalisation in private credit. And that investors are willing to say, yep, I'm going to get in, irrespective of whether the discount is ready yet. Then you get more investors, you scale up, and once you have real scale, then you can realize all the benefits that have been promised for a few years now.
Yeah, thank you very much for this very interesting perspective. Well, I understand that there is unanimous opinion that Europe is in a much better situation than other jurisdictions as a result of MiCA in combination with DLT pilot regime. But still, given that every DLT-related matters is cross-border by nature, still I do believe that there is not enough consistency if looking at the wider environment. And I would ask James to step in at this point and provide his views on how additional consistency in the regulatory responses around the world what contributes to further development of tokenization.
Great, thanks, Martina. I mean, clearly these are very big questions. Perhaps the starting point, of course, is yes, digital markets are essentially global, or should be global, or have the potential to be global. Clearly, for digital markets, and I think Fabian's list of kind of potentials and problems is very, very interesting, because for me, the biggest questions are really, okay, we recognize there is this enormous potential in digital assets, fundamentally to do with access and to do with information. So that potential is there. How do we realize it? And I definitely think there is requirements on the industry, meaning private sector requirements and also public sector requirements. Clearly, the regulatory framework is on the public sector side, and absolutely from a regulatory framework perspective, we actually do need certain things to achieve the potential. Perhaps in one word, consistency. Perhaps the old, I won't say horrible, but the old traditional word of global consistency is something you cannot escape. So I do see an importance in consistency in regulatory frameworks across the world. Perhaps a side comment here to pick up on Tom's comments. The Trump executive order, the US changes, the SEC decisions, this actually gives an opportunity to Europe, and it gives an opportunity to Europe in this area precisely because, let's say, the old Biden regime, Biden administration approach to digital assets was kind of a picture postcard case of inconsistency in global frameworks. So it's an example of what not to do. The Trump administration has stated that it is looking to create a regulatory framework. Okay, I would say fantastic. Let's see if we can get that regulatory framework to the greatest extent possible to be equivalent, to be consistent with the European regulatory framework, because that will be an opportunity for Europe. It will be an opportunity for European markets to attract outside parties. So there's nothing but positives. But I would say at the same time, there is also the challenge. Of course, you open your markets, you have to be prepared to handle that challenge. Martina, on your question, what do we need in regulatory framework? So global consistency. I would just say as well, for me, one of the critical points of what we need in the regulatory framework is consistency across different types of assets, across different types of, let's say, activities. And it's really driven by the idea that we're not going to create a new world. This is not about saying the old world is bad, the new world is good. What it is about enhancing the traditional world. And the fundamental reason for that is the power of digitalization, the power of tokenization can help us make our current world better. It can help access to markets, because we know today there are problems in access. It can make markets more transparent, because in reality, there still are problems in transparency. So just to say, opportunities, regulatory framework, consistency. I'll perhaps just add one final word about the regulatory framework, and that is we need to make sure that the regulatory framework allows for the existence of intermediaries. Back in 2016, 2017, part of the narrative was we can create a brave new world without intermediaries. But in reality, intermediaries are necessary, perform a very strong, useful function, and also intermediaries allow you to overcome one of the basic problems which we're experiencing today, which is really the network effect. You go onto a new network, day one, you're the only person, it makes no sense, it's too expensive. But intermediaries allow people, as it were, for the system as a whole, to facilitate overcoming the network effect. So just to finalize, regulatory framework needs to allow for intermediaries. Thank you.
That's a bit counterintuitive, because the typical narrative for the DLT is that it could get rid of intermediaries. But I assume, George, that you would like to react immediately to what just heard, maybe under your hat as chair of the ESMA Risk Committee. and introduce some considerations about not just benefits, but also risks attached with the greater diffusion of DLT solutions.
So let me say that there's actually a report that came out in October of last year by the FSB, the Financial Stability Board, on tokenization, where basically the report outlines that still the adoption that we have seen until now is low in terms of tokenization across the globe. So because of the small scale, we don't see any risks in relation to financial stability at the moment. And I think it's similar to what we are saying also about DeFi, right? That DeFi, it's, although there's potential, it's still a very, very small part of the market, the digital assets, so no risks to the financial stability. However, the report mentions about potential vulnerabilities if adopted at a larger scale. Talks about liquidity, maturity mismatches, leverage, interconnectedness between the digital assets markets and traditional finance, operational fragility. So it outlines a number of potential risks, basically, if this industry expands in the future. So yes, there are potential, as in any type of new technology, there are, the advantages, the opportunities of what we have been describing, but also we have to take into account that there is risks involved, and we have to monitor those risks. It doesn't mean that we will not be following the technology, but we need to monitor and mitigate the risks. And now coming back also, I wanted to comment also on the fact that there is, I think, for this industry there is a momentum, but to grow to the extent that we want to grow, basically, there needs to be a lot of investments, right? And a lot of investments which I would think that certain that the companies might be hesitant basically to pay those investments, to invest those amounts of money without understanding whether there will be the potential benefits, right? So I think it needs to be some more coordination between policymakers, between regulators, and between the industry participants, right? It has to be through a coordination, right? Because otherwise it would stay at a small scale without the benefits that we all know that we can achieve, right? So I think it needs to be a coordinated effort. And probably, the governments are the ones who have to take the initiatives, right? The governments have to take the initiatives in coordination with the industry, basically. And one last point, the fact that the US right now, with the new administration, is interested in creating this regulatory framework and spending money, and we know that the US is very good in innovating, right? So because of the fact that this is a trajectory right now that the US government is taking, I think this is a good time also for others also to take the lead, to get the potential out of this new technology.
Yeah, thank you. So leveraging on your suggestion of entailing in a continuous dialogue between the public and the private sector, let's turn to Fabian. In light of the risks that George described to us, which I found particularly worrisome, the one about interconnectedness between the digital sector and the traditional financial sector, can you explain us if companies offering and promoting tokenization somewhat consider this risk and how they specifically address them?
Sure. So I'll start micro and I'll go macro. So I like to say that digital finance is essentially finance the way we've always known it. but powered differently with some new assets here and there, including stablecoins and CBDCs and DeFi. But it's still tiny, as you said, with $120 billion today. So not much to worry about just yet. But apart from that, finance is finance. And I like to say a bond is a bond. So typically when we look at corporate bonds, bank bonds, whatever, supranational bonds when they're issued through blockchain platforms, the very first thing you do is you do your credit analysis with the primary credit risk drivers that are in your rating methodologies for those sectors, irrespective of the format, in this case of DLT. And you pretty much capture the essential of the credit risk of your bond with that. Now, of course, if you track the money, which is the point of credit analysis, and you make sure that you follow the cash flows and you check that they will go ultimately to the investors as needed, if the money can be trapped in the wrapper, in the DLT platform, that's a risk that needs to be part of the picture. Otherwise, you don't have a full credit story. So we essentially look at 4 buckets, and that's what we tell investors you should be paying attention to. The first risk is the blockchain platform itself, and it includes things like scalability, network effects. I mean, can you even just push your transaction through and make your payments when there's a lot of activity on that platform? And it includes governance. If there's an issue with the platform, can anyone step in or not? And that's not always clear, especially for large permissionless platforms, but it doesn't mean it's not possible, but it might be hard to get consent from everybody on the chain. The second one is really smart contract lifecycle, making sure that your smart contracts that are supposed to make things easier, better, and a lot quicker are not wrong, and that they've been tested properly. And if it's not the case, you could have crazy scenarios where money is supposed to go to one party, it goes to another one, and back to my point on governance, you may not be able to fix it because there's no one that's empowered to fix the bug. The third one is legal risks and asset representation. If you invest in a token, you want to make sure that all the legal rights, including ownership rights that are supposed to be transferred to the token, are indeed transferred. And there's a number of other legal questions that are complex. And then lastly, everything around external risks. So cyber, obviously, it's a hacker's dream, right? But also regulatory risk and Oracle risk, for instance. So the risk of introducing data into your blockchain platform that's otherwise isolated, and that could jeopardize your activities on the chain. So that's for the 4 risks or buckets of risk, I would say, that we look at first. Now, if you zoom out, for the longest time we've heard from the market, well, that market could impact or affect traditional finance markets. But as you said, George, it's not really big enough, and it's not been the case to date. It could happen. I mean, you have tools like stablecoins. In the year of stablecoins, as you said, James, you still have those big vehicles that have a lot of actual real-world assets that could be subject to a fire sale, and there could be panic in traditional finance markets. But what we've seen, interestingly, is the other way around as well, right? Where we've seen just last year when a regional bank in the US got weaker, let's say, a lot of the assets of a number of stablecoins were with that bank. The digital finance markets and stablecoin markets at that point were going fine, but because of issues in traditional finance, markets panicked and said, well, the assets of that stablecoin are trapped with a regular bank, so potentially we won't be able to redeem that stablecoin or those stablecoins. And a few of them depegged until the government there said, don't worry, we'll cover any losses, and suddenly the stablecoin repegged. So all that to say that contagion risk is a real one, but in both directions that we also need to keep an eye on. And obviously, you can zoom out to an even bigger level and talk about monetary risk with all those private assets out there that can compete with national currencies and all of that. So there's like a whole spectrum of risks that we look at and tell market participants about.
Allow me to introduce now a new element into the discussion and to be a bit provocative with you, Tom. The way I see tokenization is just a technologically different way to creating securities, both for twins and native tokens, And I could hardly see this to happen outside closed, permissioned networks. Is this your opinion?
In a word, no. But no, it's fun to have a more provocative kind of question at the end, and maybe in the spirit of keeping it fun, I want to pick up on a few bits, and then I will come to that. James said some things which I agree with. Consistency is really important, particularly as the US is now kind of coming online. I just want to elaborate and say, why do we want kind of global consistency? Because a lot of the benefits of this technology are kind of cross-border, right? And so if we want to send, money instantaneously around the world for 1 cent, 1 second, which we can do using our technology right now, you kind of need fungibility of those types of instruments. You also need access to global markets because there isn't Bitcoin Europe and Bitcoin America. There's just Bitcoin, right? It's a global market. We need to have access to global markets, and that's facilitated by kind of consistency. So I just wanted to add that. One part where I may be tempted to take a slightly different opinion is on the need for intermediation. I think I can agree that I think we'll reprofile intermediaries, okay? And that may be the case that you want to have as kind of a separate custodian, for example, if you're a particularly kind of big trader. But what I think we have to avoid is inventing a technology that allows for peer-to-peer transfer and then recreating an existing cluttered, expensive, slow, intermediated, paper-based, database kind of system. We have to radically reform market structure and make it more kind of streamlined. And I think that will mean, at the minimum, reprofiling intermediaries. I'm not saying get rid of all of them. I think there is a case to make for some, but I think we'll radically kind of reprofile them. I'm going to come to your question now, which is on basically kind of public permissionless kind of networks or closed ones. And look, last year, I think it was last year, the Bank of International Assessments came out with a paper on the Finternet. And it was actually great for those of us in kind of crypto because it basically said, the future of finance is tokens and ledgers. So it was like, wow, the pennies dropped in the kind of center of orthodoxy for kind of banking. But then it went on to basically describe a closed protocol, a closed system, and basically one that is kind of mediated by kind of central bank digital currency. What you're doing with that, is actually creating the hacker's dream, right, that Fabian was talking about. And decentralization is so powerful for inclusiveness, right, for resilience, for security, for innovation, for interoperability, for all of these things. And the mistake that we will make is by channeling this innovation into walled gardens, right, is a big, big mistake. Let's look back at the history and the evolution of the internet, right? We have things like TCP/IP. We have SMTP. You can send data anywhere around the world. You can build websites, okay? Because you have these underlying protocols that are open and everybody can innovate on them, right? When these things were invented, it unleashed decades of kind of economic growth and creativity. What we've seen hitherto is that the internet's kind of closed around 6 big companies, but we've got an opportunity now to rebuild the internet and financial markets on public permissionless systems that are decentralized, right? That will offer huge benefits. We've got to stop thinking about regulating the base layer. What we can do, and I think this was really well argued by the Fabien Char paper from the European Commission, you can attach regulation higher up the stack, right? You can have a neutral base layer, like the internet is a neutral base layer. We don't regulate the internet, we regulate the banking applications on top of the internet. We're not going to regulate the protocols, we're going to regulate the applications that sit on top of it. And then the other kind of concern that lots of folks have is with kind of KYC and KYT, et cetera. I think the only important point to make is that there is a vast amount of, I think, kind of exciting development going on in traceability of blockchain transactions and blockchain analysis that allows so much more transparency than you have when you're just dealing with walled gardens and closed systems. Whereas banks can only see their own ledger. They can only see one step. We can see multiple steps. And using this very advanced blockchain analysis, you can figure out pretty much where the money's going and who it belongs to, and then you can grab the people when they off-ramp through a KYC entity. So look, our conviction is that there'll be a mixture of permissioned and permissionless systems. But we think actually if we really want to extract and capitalize on the real benefit of this technology, it's going to be using these big public permissionless, secure, safe, resilient networks, and then building financial applications on top.
I would say again, MiCA seems to be the perfect regulation because it is not concerned with regulating the engine, but the activities performed on that. So we're really on a good track. It's not me, but no panel can end without this request. Starting from James, please, and following the order, to leave our audience with a final very short message, just a few seconds each.
Great. This is a massive topic, so I'm suddenly stumped with a single message. What is the single message? The single message has to be, wow. Clearly, there's enormous potential. I'll perhaps come back to my point about Europe and the challenge for Europe. And I think really we have momentum. This is a year of inflection. I would say, what are the core elements of that potential, keep that momentum moving forward? So clearly we have MiCA pilot regime ongoing. So perhaps just two comments. One is central bank money, wholesale central bank money, ECB trials and experiments, very, very, very important in the last year in developing the market, in particular for bonds. So perhaps my one wish will be that this year, Nick, did you mention that you believe that the ECB will be announcing something in May?
We were understood that they might, yes. I can't speak on their behalf, but...
Great. I'm looking forward to an announcement by the ECB in May that will take the story forward. Thank you.
Okay, my message, I think it's there is certainly a lot of potential, a lot of opportunities, but to extract this potential, a lot of more work needs to be done, a lot more coordination needs to be done between all the stakeholders. So everybody has to chip in, everybody has to participate, industry, the regulatory bodies, and obviously the policymakers and the governments to unleash this potential. So I think we're still at an early stage of this era, which might take years to see the full potential, but it's there basically. It's there, and hopefully in the future we will be discussing about the digitalization of all the markets.
I'd say it's been getting better, but for many years the discussions always started with the technology. There's been a shift, not big enough yet, where I think it's time to talk about what's in it from a financial economic perspective. Until we do that, a lot of market participants, in particular those that are on a technical, will think you're trying to sell a solution to a problem that I don't even see. And it's just naturally getting better, but it's not completely there. And then at that point, you can kind of remove the technology from the equation because experts will be looking at that and telling you about the risks similar to the internet or whatnot. And probably at some point, with more maturity, when the technology becomes mainstream, you won't have to worry too much about the technology per se. Back to your point, Martina, it's going to be really a question about looking at the applications, what's going on the technology. For now, it's great to keep an eye on it, again, because of the lack of track record, but certainly it's time to talk about financial and economic benefits more than the technology itself.
I can be quick. I think this year is exciting. We've got MiCA. It provides regulatory clarity. Let's now try and commercialize that, right? There's a kind of 8 to 12 month kind of head start on some other regions. And let's also think about how this technology, to pick up on the point Fabian was making, how it contributes to some of the bigger goals that Europe has. I've been coming to conferences like this for more than a decade, and we talk about, a fragmented kind of, banking kind of, regime here. We talk about dislocated capital markets. I think there are 41 different kind of, trading venues across Europe. I like the idea that was kind of mooted at the ECB about a digital capital markets union. I like the idea of thinking about how we can, elevate this technology and think about it more strategically as a way to integrate and streamline banking and capital markets in Europe, ultimately to make Europe more competitive. So I think that's the goal here. I think it's a worthy one, and Europe has done really well to set the base, and now is a great time to try and commercialize it.